Good morning, everyone. So today I'd like to talk to you about the crisis in the global economy and also the opportunities that exist to us as a global society, really as a result of this crisis. Over the last couple of decades, two things have developed that have fundamentally changed the way that our economic system works. The first was when we broke the link between money and gold around 1968. And the second was globalization. Breaking the link between money and gold, that allowed an explosion of credit to occur. Globalization has been extremely deflationary, and that deflation has offset the inflation that would have occurred as a result of the explosion of credit. So these two things combined have resulted in the greatest economic boom in history. The problem is now it appears that this 50-year unprecedented global economic boom is on the verge of collapsing into what could be an equally protracted and severe depression. So over the next only 30 minutes, I want to give you a framework that I hope will help you understand how this global economic crisis came about and what is going to happen next, as well as the possibilities that are open to us if we actually take advantage of the opportunities that exist within our new economic system. So I'll begin by talking about the United States, because the U.S. is still by far the largest economy in the world. It has been the driver of global economic growth since at least World War II. And what happens there is the most important development that will affect the rest of the world more than everything else. But from there, then I'll talk about the rest of the global economy and bring that down even to the European level. So first, let me show you this chart. This chart shows total credit market debt in the United States. Now, what I mean by that, debt and credit are two sides of the same coin. So what this represents is all the debt in the United States: government debt, household sector debt, corporate debt, financial sector debt, all the debt. Okay, notice that it first went through $1 trillion in 1964. And over the following 43 years, it expanded 50 times to $50 trillion, from 1 trillion to 50 trillion in 43 years. That explosion of debt created our world. It made us all much more prosperous than we would have been otherwise, and it ushered in the age of globalization. We take it completely for granted, as if this is just something completely natural. But I assure you, this is something that has never occurred before. And the only reason that it was possible for this to come about is because we broke the link between money and gold in 1968. In this chart shows all the paper money in the United States. There was a law that the United States Central Bank had to maintain gold backing for all of the dollars that it issued, at least 25% gold backing. But in 1968, they changed the law, and they removed that necessity for the Fed to maintain gold backing. And afterwards, this allowed the Fed to issue another trillion paper dollars, 20 times as many dollars as had existed before this link was broken. And this $1 trillion of paper money creation, that is the foundation upon which the $50 trillion of credit was built. Had we remained on a gold standard instead of a fiat paper money system, it would not have been possible for our banking system, for our financial system, to create $50 trillion worth of credit. Now, as long as credit is expanding rapidly, it's very easy to understand how this drives economic growth. As long as credit's expanding rapidly, everyone has more money to spend, so the consumers spend more. Therefore, the businesses are more profitable, they hire more workers, they expand their capacity, they build some new headquarters, they even pay more taxes. So the government has more money to spend. And meanwhile, asset prices inflate, creating an upward spiral of increasing prosperity and creating more collateral for the consumers to borrow against. So as long as credit's growing rapidly, it's very easy to understand how that drives economic growth. The problem is the day always comes when credit can't expand any further. And the reason that is because eventually credit expands so much that the income of the people is insufficient to service the interest on all the debt. And when that happens, then credit begins to contract. And at that point, the prosperity created by the credit, it doesn't just plateau at a very high level, it begins to spiral into reverse. And that's when the Depression begins. Well, that point was reached in the United States in 2008 when the household sector began defaulting on its debt. And it's only been the increase in government sector debt since that time that's prevented us from spiraling into a debt deflation death spiral. Now notice, as a ratio of GDP, it was around 150% of GDP for quite a long time. But then under President Reagan cut taxes and increased military spending, and that caused very large budget deficits, and that caused the overall debt of the country to expand to 230%. And then more recently, the households expanded their debt, fueled by Fannie and Freddie and the expansion of their debt, and that took the overall debt in the country up to 370% of GDP. But at that point, the households started defaulting, and that's when the global crisis started. This chart shows the year-on-year increase in total credit, the number that I've been talking about, going back to 1952, the year-on-year increase. Now notice that it ranges from roughly 4% to 16%. But this is not adjusted for inflation. It should be. So that's what happens in the next chart. Now notice in the next chart, here things become more interesting. Going back to 1952, adjusted for inflation, there have only been 9 years when credit grew by less than 2%. Every time that happened, there was a recession. And the recession didn't end until there was another big surge of credit expansion. For example, I've already mentioned President Reagan. We had a very severe recession here when Paul Volcker crushed inflation with very high interest rates. Then President Reagan was elected. He increased the government's debt very sharply, so the country's debt started growing by 8%, 10%, 12%, 12% in the 80s, and that increase in government debt fueled the prosperity of the 1980s and into this very severe recession. Okay, now the next chart shows this more clearly. The red line is the GDP growth, also adjusted for inflation. So again, going back to 1952, only 9 years when credit grew by less than 2%. Every time that happened, there was a recession. And the recession didn't end until there was another big surge of credit expansion. Okay, so of course this begs the question, what about the future? Is there going to be more credit growth in the US, or is there not going to be more credit growth in the US? Well, before I answer that, let me point out one other interesting thing in this chart. Notice that in the first half of the period, the two bars move pretty closely together. But in the second half of the period, the credit growth bar is much higher than the GDP growth bar. The explanation for that is that only beginning in 1980 did the United States start running a very big trade deficit with the rest of the world. By the mid-80s, it was 3.5% of GDP, and by 2006, it was 6% of GDP. So what that means is that, okay, this credit growth, it was creating economic growth. It just wasn't creating it in the US.